Hello, this is our week 4 for income tax. We are going to be looking at the middle section of the 1040, which is all about different types of income, what is taxable, and what can you get and not have to pay taxes on per the tax code. So what we're gonna dive right in here, and then we're at the very end. We're gonna go through some questions in the back of the chapter to kind of tie up everything we've done in this chapter, make sure we've got it all done. All right, so when we start out here, the first thing that you should know is in tax, you can choose the cash method or the accrual method, but a lot of small businesses will default to the cash method, and they may only keep the cash method as they keep their books if they don't need to ever use their accounting records for anything more official, if they don't need to go get a major loan or do anything through whatever they may need to do. If it doesn't need to be official through GAAP, they may only stick with the cash method. And the good thing about the cash method is, for tax people, is it's called the wherewithal to pay concept, meaning it would be really hard if, like in accrual accounting, if you have income that you have earned but you haven't received it yet because it's on account receivable. In tax, if you use the accrual method, you're going to have to pay tax on that income, but you don't have any cash to pay that tax. So that's why you are allowed to use the cash method, which means you only record your revenue when it's received and you only record your expenses when they are paid, which is not how GAAP has you do things. Remember, you record revenues when it happens or expenses when they occur, not necessarily when they're paid. So if you hear of people having two sets of books, that may be one of the reasons why. Okay, in this class, we're going to talk about these 3 different types of income. The main one we're going to look at is the active type of income, and that's going to take up most of this class. A few things that we will touch on a little bit even today is the different types of portfolio incomes, and these are mainly your dividend income and interest income. So if you have interest income coming in from, say, owning some bonds, that would be a portfolio type income. And then, of course, dividends is if you own stock. This passive real estate income, there are other types of passive income, but the main one that most people that we'll definitely see in this class is from real estate. Real estate we will talk at the very end of the semester. But for primarily starting out here, we're going to look at some active type wages. And I thought it would be good to go ahead and just list the most common types of wages that you'll find, ways that you can earn money that you have to include in your income. Now, the general rule in tax says if you receive income, it is taxable unless otherwise excluded. So you can never default and say, well, I didn't know if it was taxable or not, so I just decided it wasn't. That's not how the rule states. The rule states it is taxable unless you know that it's not for sure, and you can find and prove it through the tax code. All right, so common taxable items, you can see here your normal W-2 items. And then on the 1040, these are the lines 8 and 9. Remember seeing the interest and the dividends. Alimony, if you Indiana is a no alimony state, so you won't see that here in Indiana. But other states, if you're divorced and you get income from your spouse and it's not considered child support, that is taxable. Unemployment, this is one that kind of gets confusing sometimes, and a lot of people get this confused, unemployment with workman's comp. They are 2 different things. Unemployment, that's pretty self-explanatory. You get money when you get laid off, if you apply for it and you were laid off for good reason, not fired. Workman's comp is if you are not working because you were injured on the job. Workman's comp is not taxable. That money you get is not taxed. However, unemployment is. That's there in the middle section of the 1040 as well. You'll see unemployment towards the bottom of the middle section. Retirement income, there are a few exceptions, and we're going to talk a whole bunch about that right after our first midterm, or the only midterm. We're going to talk about retirement income. The only one that's not right off, so you can know, it's called a Roth a Roth type account, a Roth IRA, because you're paying your taxes up front, and you're not paying, then you don't have to pay the taxes on the back end when you take it out, and nor on the earnings. Hobby income is another type. A lot of people will get money through weird little things. Maybe you go out and on one weekend and you judge at a fair and they pay you $250. That money, you may not ever report it thinking, well, it's not taxable. It actually is. Anything you do on the side to earn money and you actually did something like judge, whatever it is, that is considered taxable income, and you would typically report that as other income at the bottom of the middle section of your 1040. Some other items that are still taxable, but you don't run across these on a day-to-day or even year-to-year basis. If you ever win a prize, so if you win something on a radio show, they give out a prize, you won a free trip, that is considered taxable income. The value of that trip, you're going to have to come up with that cash to pay. Any other rewards that you may find? One of the other ones here with the prizes, if you go on The Price is Right, you win something, they typically will give you a cash option. Say you won a new Cadillac. That Cadillac may be valued at $60,000. You're gonna, if you take the Cadillac, in your income, you would have to add $60,000 and be able to pay tax on that. So that's going to bump you up at least another tax bracket. So you may be looking at 25% tax on that $60,000 automobile. So you somehow are going to have to come up with nearly $20,000 just to get your free car. So that's why a lot of people will have to take the cash option, because they can't. There's no way they'll have that kind of money. So does that to me doesn't seem fair, but that's how the law is written. That's going to be one of your discussion board questions as well for this week, is if you win a prize or other items, why is it taxed? Is it fair in your opinion? And that's just my opinion. I think if you win a prize and it's a legitimate win, it's not somebody actually giving you something for other purposes, then you should get that. You shouldn't have to turn it down only for tax reasons. Another one here, state and local tax refunds. Notice I said state and local, not federal. If you get a federal refund, that's not taxed. State and local, if you get a refund back and you did not itemize last year, that's why I put the pins. If you itemized the year before when you got your refund, then there's a good chance your state and local refunds will be taxable. If you did itemize in the year prior when you got that refund, then your state and local taxes are not taxable. So state and local taxes do depend. It doesn't always mean they are taxable, but if they are, they go on line 10 of the 1040, and we will have some of those on tax returns coming up in the future. Another thing is, you may say, I'm an accountant and I have a friend who's a mechanic. If I do his books, he'll fix my car and we'll do it on an even swap, no money changing hands. Technically, if you were to do everything the way the IRS and the tax law says, you are considered to have income in that type of situation. Whatever you would have billed somebody like this auto mechanic, if he didn't do you as the service in return, whatever you would have billed him on for just a normal person, that you do have to consider and put down as taxable income. You can't just do an even trade. That doesn't work for the IRS, or more specifically for Congress. And then the last one, or the last couple here, damages for the non-physical being the key here, injuries. So if you get for some kind of restitution and it's considered punitive damages, those are cases where that kind of income will be taxable. There's a one that goes back and forth through court situations, because the key word here is non-physical. So if you have mental suffering because of, or it caused you to go into, a deep depression, and that's one of the reasons why you're getting money back, or you won your lawsuit, that has been shown in some court cases to be a non-physical. Therefore, you do have to pay tax on the earnings you get for a mental type of settlement, for a mental type of injury rewards. So that one is the one that could be very iffy. But any type of judgments you get to pay hospital bills or for a leg injury or something, that would be obviously considered physical, and you do not have to pay taxes on any of those damages or rewards coming back. Gains from illegal activity, that's the last one I have on there. That would be if you are a drug salesman, they can easily, if you get caught with drugs and then you haven't reported it to the IRS that you are earning money on the side through your drug trade, they could then nail you again for failure to report income and have you have different felonies tacked on to your record. Non-taxable items. If you get a gift, so these are items that do not have to go on a 1040 anywhere. Gift would be one of the big ones. Gifts, you have to always make sure with a gift that there was no type of work associated with it. You can't get a gift and then expect something in return. Give a gift and then expect something in return. Then it's no longer considered a gift. A gift is usually something that's usually between family members. Notice the gift yearly value. It's been the same for the last few years. It's still at $14,000, and that is a $14,000 per individual. So if you are married and you want to give your adult son, you could give them $28,000 from you, and then 14 from your spouse, and it not have to show up on anybody's return, nor would you have to file a gift tax return if you're the giver, because only the givers have to file a gift tax return, and that is if they give a gift over $14,000. Now you could give as much as 28 plus 28 if your son was married, because each of you could give 14,000 to your son, and each of you give 14,000 to his wife, and therefore instead of 28, now you're looking at 56,000 you would be allowed to give away per year, and it'd be totally legal. And so that begins to come in play when people are older and they know that they may have to go into a nursing home in the near future. The nursing home will still probably look back, but at least for tax purposes, you can't give it all away in the years before you go into a nursing home. But the nursing home will always look back too. They'll have some kind of a rule that says anything in the past 5 years, we are going to consider yours, and that was an evasion of trying not have to pay your nursing home bills. But for tax purposes, you can get away with doing up to 58,000 or 56 a year for that in that situation. And inheritance. So if somebody dies in your family and you are left with the house, you get to keep the house and you don't have to pay tax on it. The only time you would have to pay tax on the house is then if you turn around and sell it. And then if you sold it, the only one you'd have to pay a tax on is if there was a gain. If you get the inheritance and it's worth $100,000 when you get the home, you sell it for $110,000, you would have to pay a tax then on that $10,000 gain. That's it, not on the whole $110,000, which is a nice benefit. Anything else too, as long as you get it. We're going to talk about stocks in a much later time frame, but just to quickly mention it here, if your elderly parents had stock that they bought way back a long time ago, say in the 1960s, and they bought it for really cheap, you can actually, and so if say it's at $3 value and now it's worth $30 a piece, so there's a big jump there, especially if you have lots of stock, you get to take what's called the stepped up basis. So you get the stock at whatever it is when they die, say $30, and you do not have to pay that tax in between the $27 gain that there was. Scholarships and tuition. If your scholarships go to tuition and books, that is free money, free money. Now, if your scholarships go to tuition and books and then you have some left over, and the school sends you a check then for say $2,800 to help you with other items, school supplies, but generally it goes to things like rent, that is considered taxable income. So any type of scholarships that you actually get money back, that is taxable. That's one thing that a lot of people don't realize. Qualified tuition payments. If you get this money, if somebody set up what's called a Section 529 plan on your behalf, maybe when you were very young, and they put money into it, you can take that money out and the interest and not have to pay tax on it as long as it goes towards educational expenses. Child support, that's one that's definitely not taxed. So if you get money from an ex-spouse and it's deemed for child support, that is tax-free. Any TANF type payments, TANF, which is also considered welfare payments, those are tax-free. Workman's comp, that we talked about that, the difference between that and unemployment. This is one that comes up sometimes. Municipal, state, and local bonds. The interest you may get, we're going to look at some of those when we do tax returns. But any type of state and local bonds that you have are considered tax-free. I knew one, I didn't know him, but I knew somebody who worked as an accountant, as a CPA, who did the return for somebody who happened to have a lot of money through inheritance, and his only job is he buys and sells in municipal bonds, and he collects interest. He had over $2 million earnings in interest for the prior year, and he paid zero in income tax. So he didn't have to work. He lived on the $2 million that he received every year from his municipal bonds and had to pay no tax. So I wonder how you feel about that. I thought that was kind of interesting. Any reimbursements that you get from your employment, if you go out and have to pay money and then you submit a reimbursement, that is not taxable either. So that's good. But it shouldn't be. Non-taxable items that are not so common. Life insurance proceeds, if somebody dies and you are the beneficiary, just like an inheritance, you are not taxed on the life insurance proceeds, on that lump sum. On any interest that earns later, you would be taxed on. Any money that you might get back through a court case to get you back to where you were, like to repair your car, to get you back into the position you were before the wreck, any type of those repayments are not taxed. Winning the Olympic gold medal, this is a new one. Up until just a couple years ago, winning the gold medal, you get a $25,000 reward. Up until just a couple years ago, this was taxable. It has just been put on the books as a now non-taxable item that Olympic gold medalists do not have to pay tax. Meals and lodging for the employer's convenience. This one is key. It has to be for the employer's convenience, which means they need, if it's for a meal and they're serving you a free lunch, that means mainly because they have to have somebody there available at the phone or whatever it might be, and you're the only one there. So they can't have you leave and go get your lunch. If they provide it and they need you to stay there, that would be for the employer convenience. Therefore, you don't have to pay tax. The other one, and there's a few stipulations that go along with that, and that you would, if that ever came into play, you'd want to look at that. And I think we'll talk about this in a little bit more in a little bit as well, because one thing that comes up then, what about if policemen get free meals? Is that for the employer convenience? Are they still on duty? True, they are. Are they able to go to and get a call if it comes in? Sure. The other thing that goes along with this employer convenience is it has to be on employer premises. And so that's where the policeman thing comes up. Usually when the employer is eating and say they get a stipend that says that you get X dollar number to eat out while you're on your shift, maybe it's $50, whatever it is that considered on the employer's premise? Well, what is the police department's premise? Is it only where they have the office, or is it the entire city where they are in patrol? That's kind of a question that I thought was pretty interesting to think about. All right, you might want to read this. If you haven't ever seen this link, it went viral a few years back. It was about a guy who found a girl who had been kidnapped, and then he was eating a Big Mac, and McDonald's gave him free hamburgers for the whole year, free Big Macs. Should that be considered taxable income? So you may want to look at that case. I think that was a it's an interesting read to see if he should be taxed or not, and they kind of give pros and cons either way. Tips, I'm going to kind of skip through this fairly fast. Basically, the employer is allowed to tack on to your income if you did not report a certain amount of tips. If you did not report at least 8% of the gross sales that you made, not including carryout sales, if you did not report at least 8%, they then will tack on and say you earned that, and you will pay taxes on that. The only way to get around that is if you can show the IRS that you have kept daily logs that says this is how much you got in tips every day, and you keep it very accurate. Then you could be able to fight that 8%. You say, hey, I had a bad day. Nobody was giving me tips. I shouldn't have an extra $30 added onto my income. I never earned it. All right, income and dividends. When we are looking at the different schedules, there are 5 main schedules that we are going to look at in this class: A, B, C, D, and E. We're going to look at Schedule A in 2 weeks, but Schedule B comes up here. Schedule B is very simple. All it is just a listing of lines and then a dollar amounts, and all it concerns is income and dividends. If you earn interest or dividends of $1,500 or more in either one of those 2 categories, not both combined, just either one, then you need to fill out a Schedule B and show where those interest and dividends came from. Now, any type of interest, that has to be, of course, this is taxable interest. Interests that are from local municipalities that are not taxed, you still would put them on Schedule B to show that they are and indicate that they are not taxed. The bonds from interest from local municipalities, generally they're going to have a lower return, what's called an after, and then you got to think about the after tax rate. So if a taxable type stock will give you, or some type of taxable interest will give you a 10% return, which is really high, compared to an 8% if you get a municipal bond. You might think, well, I'm going to go with the 10% every day. Well, then you got to think about it. I have to pay tax on that 10% for-profit type interest. I don't have to pay taxes on the 8%. So is it actually better to take the 8% when you factor in how much tax I'm going to have to pay? That's what's called the after-tax return rate, or the after-tax rate. So what you can see here how you do that. The tax-free interest rate, say in my example, was 8%. You then divide that by 1 minus whatever your marginal rate is. Remember, the marginal rate is what tax bracket are you in? If you earn just $1 more, how much are you going to pay in taxes on that? So that's not to be confused with your average rate. This is your marginal rate. So I asked the question here, if you, instead of the 10 and 8, what I gave you, if you were getting a 7% tax exempt interest, is that better than getting a 8.5% regular taxable interest? And we'll answer this in 2 different scenarios, because it all depends which tax bracket are you in. If you're in a high tax bracket, we're going to see that it's actually better to have the lower rate but not have to pay taxes on it. So let's see how that works. 7% rate, 28% bracket, you do the math right here. 0.07 as our tax rate, divided by 1 minus the marginal. So divided by 0.72, and you're going to get an after-tax rate of 9.7%. And then you're going to compare that to the rate that is taxable, the 8.5% rate. It's better for you to choose this 7% rate, because when you compare it, the 9.72 is obviously the better route. You want to do the 7% bond because it's like getting 9.72%. Now, comparison here with the lower tax bracket individual. For them, it's better to be on the take the higher interest because you're not going to pay that much in tax. So if you take that, if you would do the math, 7% divided by 1 minus 0.0 basically, so 0.07 divided by 0.9, your after-tax rate is really only 7.77% compared to the 8.5%. So it's better to take the taxable interest in that case. Dividends. All right, so we're kind of progressing down. I try to make this as we go through in somewhat logical order. So the first one we did up here, the interest, that's line 8 of the 1040. We're now on line 9 of the 1040. There are 2 types of dividends. You always hope that your dividends will be what's considered qualified dividends. And I give you what it takes for a dividend that you receive to be qualified. In a sense, if you're a day trader and you are constantly buying and selling stock and you don't own it for very long, but you happen to own it during a dividend date, your dividends probably are not considered qualified. The other one is it won't be considered qualified if it's not a U.S. corporation or a foreign qualified. So whatever the qualified is, you can go here. I don't know. Whenever you get the dividend, it will specifically tell you if it's qualified or not. But the key factor why it's better to be qualified is this. If you have a qualified dividend and you're in the lower 2 tax brackets, whatever you receive as a dividend, you're not going to pay any tax on it, which is a great benefit. If you're in the middle to upper brackets, so you're somewhere in the 20s or the low 30s, you're only going to pay tax like you're in the 15% bracket. So it's still a savings. If you're in that highest bracket, almost 40, again, you're going to save half because it's considered a qualified dividend. So those are really nice options if it's considered a qualified dividend. Child earnings. We talked about this when we were doing tax returns. The overall rule of thumb here is if your child earns money, gets a W-2, they need to file their own return. Even if they can't sign or something, you would sign for them, as you can see here. If they only have dividend and interest income, you can opt to include that in your own parent tax return, although most of the time it's better to not. It's better for the child to do their own because most likely they're going to have a lower tax rate than you do, unless your child happens to be Mary Kate and Ashley Olsen, where they make a lot of money as a baby, then it may not be in the best interest. So that's what I got here. Is there ever a time when parents can claim their child's income? Yes, but it's pretty minimal. They have to only be interest and dividends, and it has to be less than, at least for 2016, $10,500. But again, it's best if the child probably does it on their own because it's a good chance that the parent is in a higher tax bracket than the child. Child care. If you pay for somebody in child care and you actually take the child to their place, you don't have to worry about any type of showing the government that you paid them. If you don't want to, you don't have to. However, if you have somebody come to your home and watch kids at your house and you pay them over $2,000 a year, which is a very small amount when you really think about it, for child care over a whole year, that person is considered your employee and you are responsible for treating them as such. You need to pay, you need to withhold and also pay your portion of Social Security tax and Medicare, as well as federal and state. You're going to need to take it out of their check, normal payroll deductions. So that is kind of an odd one to me, as a lot of people may have a nanny, especially more wealthy people, and may not know this rule. But if they're more wealthy, they may have a CPA or accountant, and then they would. So hopefully that would be taken care of. If you are the babysitter on the side, and all you do is just babysit on the weekends, and it's not for anything real particular, generally you're not going to have Nobody has to withhold money for you. However, you would count that as part of maybe like a hobby income. Qualified tuition plans, you see what, if you get money, the interest. So what this is somebody puts money into a bank for you on your behalf, maybe as a child. It grows, so you had 1,000, now it's up to 2,000 because of interest that was earned. You get to take that 1,000 plus the interest and not be taxed. So that's a way to earn money and not have tax, as long as it goes towards school type items, tuition, books, even room and board, anything that's needed for school. Okay, let's keep going down. Alimony rules for something I'm not gonna spend a lot of time here because Indiana's not an alimony state, but you can see just a few of the things. Alimony has to be in cash and received by the spouse. It can't be directed to go somewhere else to be considered alimony. Has to be part of the divorce decree. You can't just say, I'm going to pay you money just because I want to. That doesn't count as part of alimony. That's something different. And the other biggie here, it can't be considered child support. Now, what if in a divorce decree, one of the spouses gets the car, one of the spouses gets the house? What happens is the person who gets the item, they're going to keep the original basis. We're going to talk a lot more about basis in the second half of the semester, but just suffice to say, if a 20,000 piece of property was divvied up and one of the spouses got it, if they would turn around and sell it the next day for 20,000, they wouldn't have any gain or loss to report. However, if they turn around and sell it, say 5 years from now, and they get 30,000, they would have a gain in that situation of $10,000 when they sell it. But what this question here says, a $20,000 property is given to the spouse. It's now worth $30,000 at the date of the divorce. Does the person who gets the house have to claim a gain or loss? And the answer is no, not until they turn around and sell it. So at the date of the divorce, there is no gain or loss. And the receiver's basis, so the spouse that got the house, they would keep this original basis of what they paid for it when they were married. If they turn around and sell it sometime later and get cash for it, then they would pay that $10,000 gain. Prizes and awards, I talked about this at the beginning of the lecture. If you did something or anything, you made a call, you called into the radio show, that's you doing something, then you are taxable. You are considered taxable for that prize. Or any reward that you found, that you earned, is considered taxable. The only thing that's not taxed, that's specifically exempt, is if you have an employee achievement award from your employer, and if that award is for a length of service or a safety achievement. Gifts have to be under $1,600 as long as the company has a qualified plan in place. If it's under $1,600, that can be a tax-free award. Life insurance proceeds. When you get money because of somebody's death, that's not taxed, as we talked about. There are a few other limited times when you can get life insurance proceeds even though you are still alive and it not be taxed. So if you're terminally ill, which means you have been diagnosed that you will die within the next, and I want to say it's 24 months, but it may only be 12. Don't quote me on that, but I think it's 24. You can use this money, this tax-free money that you get can be used for anything, whether it's your health care or you want to take a last-minute vacation before you die. You can receive the money and not be taxed. If you're chronically ill, it means you're not going to die within 2 years. You're just going to always have this illness and you're going to need money to pay for it. You can withdraw life insurance proceeds, but you're only going to be not taxed on if those proceeds went to long-term care. Gift and inheritances, I talked about that, the $14,000 rule. Key words here is they must be truly a gift and no services or anything business related is attached. Meals and lodgings. Remember, it was for the convenience of the employer. The second key here is it's served on the business premises. So that's when I talked about with the police situation. If a police gets $50 stipend every week to pay for meals while on a job, should that be considered tax-free? Because is it technically on the business premises? Well, I think you could argue either way. Employee must be available to work on the lunch shift. So usually a policeman is still on duty during that shift. Lodging, if you're out, say, on an oil rig and there's no way for you to get back home on a nightly basis and the employer pays for that, that is considered free lodging and you don't have to pay taxes on it. Social Security benefits. This is another one that's a maybe. So the state and local tax refunds, that was our first maybe. This is another maybe, but it's a maybe for other reasons. It's a maybe because it all depends on how much other income you have. And I mean, it would depend on how much Social Security total you receive as well. So Social Security, what they're going to look at is what's considered your modified adjusted gross income. Your modified means they're going to take some things into account that aren't normally taxable, and they're not, or they won't take other items that normally are taxable into account. So as you'll see down here, what they consider a modified AGI. So your modified AGI, don't count Social Security in it. They are going to include your AGI, your normal AGI, plus any of those tax exempt interests. Like that person who got $2 million in interest every year, that would be considered part of his MAGI. And then they're going to add in 50% of your Social Security benefits to whatever your AGI was. Remember, without it, they're going to tack on 50%. And then if you took an educational interest deduction, or a deduction for tuition and fees, they're going to add that back as well. For whatever reason, they add those back, those two in particular. We're going to talk about these next week, these two, so just know that they're out there. Now, what it's going to look like. If you are below this lower base figure, if your modified adjusted gross income, after you look at all of this, if it's lower than $32,000 as a married couple, then none of your Social Security will be taxed. If it's in between these two, 32 and 44, then you're going to have to follow these two steps. And we're going to look at that and do an example. If it falls over, if your modified AGI falls over 44,000, the rule of thumb is then at that point, you are going to be taxed at 85% of whatever your Social Security was. So what that means is you don't pay 85% in tax. If you earned $1,000 in Social Security, they're going to put it on your tax return like you earned $850. So instead of putting all 100%, 1,000, they'll give you a tiny bit of a break and say we'll put on $850. So let's look at this example here on example B. This person has an AGI, not looking at Social Security yet, of $22,000. They have $4,000 in tax exempt interest. Social Security they received is a $12,000 worth for the year. If this person is single, first off, what is their modified adjusted gross income? And then how much would we need to show that is taxable on the 1040? So at this point, go through. I'd like for you to hit pause, try to answer these two, and then I'm going to go through the answers in just a few seconds. Okay, so here's the 1040, and I wanted to show you what I meant when I said put it on line 20B. It sounds kind of weird. Well, when you have Social Security, you're going to put the full amount here on line 20A, but only the taxable part goes over here to 20B. This is where you would add up everything that goes into your adjusted gross income. So, like for one, the tax exempt interest, it still goes on your 1040, it just doesn't get it added in. But they need to know it they need to know your tax exempt interest for calculations such as Social Security. So in this case, when the individual got $12,000 in Social Security, the full $12,000 is going to go right here. We want to know what goes over here in line 20B. So I'm going to pull up the answers for this problem. So the first thing we need to look at is their modified adjusted gross income. Their modified adjusted gross income kind of looks like this. They have the $22,000 plus the $4,000 in tax exempt plus half of the Social Security they received, gives them modified adjusted gross income of $32,000. If we look at our little box for somebody who is single, $32,000, they are at, if you're at $32,000 or below, you get to have 0 taxable. So this person actually hits that qualification, and none of their Social Security is taxed. So while line 20A is $12,000, line 20B, the most important one, is 0. And that's, I think I give you the answers. Well, here's, let's do the married filing joint. The married filing joint, go back up here, 32,000 is what we're looking for. 32,000 falls in between the lower and the upper base. So now, since it falls in between, we're going to do this. We're going to take the lesser of 50% of the Social Security. 50% of 12,000 is 6, or 50% of the MAGI minus the lower base amount. So the modified AGI was 32,000. 32 minus 25. 32 minus 25 is 7,000. It says 50% of 7,000 then would be 3,500. So of the 12,000, 3,500 is taxable. All right. Gambling. Gambling, by default, you're taxed at a flat 25% rate because not a lot of people know right off the top of their head what their marginal tax rate is. So a casino is allowed to take off 25% of whatever your winnings are if they are over the threshold of, because each one has a different threshold, each type of earnings, and they will take off 25%. Now that may not be enough. If you're in the really high income tax bracket, they may need to take out more, but they're going to take out a flat 25% typically. Even if you don't win enough for the casino to actually send you what's called a W-2G, you are technically still supposed to report it. So if you go and win $400 on a slot machine, and even though you might lose the $400 later that evening on additional slots, that $400 that you win, that was your choice then to go ahead and blow it on more gambling. You are taxed on that initial $400. Same thing with even if you say, well, I won $1,200, but then I blew it the rest of the night on poker, doesn't matter. The $1,200 is considered taxable. Now the casinos, this is just for your extra information. Of course, they're going to know this, but I thought these were important or just fun to know. The winnings, $1,200, they will send you that form if you won $1,200 in a bingo or slot machine, $1,500 in Keno, $5,000 from a poker tournament, and then the normal amount is $600 for anything else that's considered. They'll usually take out $600, or if it was at least 300 times the wager amount. So for penny slots, that wouldn't be all that much. It'd actually be like $30. I don't think they will do that, but they could. They definitely will do it at the 600 as long as it's, but again, that slot, that does fall under here under the exceptions. So the slot machines, it's the $1,200. Winnings are subject to federal tax. Okay, employee fringe benefits. These are things that are considered not taxed. They have to be specifically excluded on here to be not taxed. So if your employer provides you with dependent care, meaning you get a $5,000 free benefit basically because your employer has dependent care, that's considered not taxed. That's a nice benefit. Flexible spending, you get, flexible spending, that's one of them on here. If you get money taken out of your paycheck, you can use it for medical drugs typically, and you don't have to pay tax. Health savings account. You can see what you have to be in the health savings, even to have this option. Health savings account and the flexible spending are very similar. Flexible spending is a use it or lose it type item. However, health savings accounts are for those with a really high deductible. As long as your deductible is over $6,750 or $3,400, you are considered in the high deductible and you would qualify for HSA. HSA says you can put money aside to pay for your medical bills. I'm sorry, this is not the deductible amount. This is the amount that you are allowed to put away. What's considered a high deductible, I have that other places, but I don't have it here. You can easily look that up to see what is considered a high deductible for an HSA if you are interested. Public transportation, if your employer provides you with free parking and it's a value of under $250 a month, that can be tax-free. A lot of employers do have group term life insurance as long as it's under $50,000 premiums. Your benefit would be under $50,000. The premiums that your employer pays are tax-free, which is nice. So if the employer pays, say, $100 for you to have this group term life insurance, as long as your benefit is going to be less than $50,000 should you die, those premiums are free of tax. You don't have to add that into your income. No additional cost services. So what this is actually service. You must receive a service. So say you work at a lawyer company and then you have some kind of a legal situation happen and one of the lawyers helps you out. They provide you a service. That can be considered a as long as there was no additional costs associated with that, that can be a tax-free type benefit. Otherwise, you would have to pay for that type of benefit. If you got $500 free lawyer help, you would have to pay tax like you got a $500 benefit. Employer does not incur substantial costs, so that means they may have some, but not the keyword there is substantial. And it's the normal things that employer provides. The one thing with it, what I mean by this is some companies will do various services. For example, one company may have a train service, and on the other side, the same company also does car rentals. You could not get a free car rental if your primary job is working on the train side. That's what they mean by it has to be in your normal course of business where you work. Even though the company may do lots of things, it's only for where you work, the type of company and work that you do. Employee discounts, you can read through these. These are actually for actual products. As long as the discount isn't at least or over 20% off of what the customer would normally pay, that can be a discount free. So if you get a 20% discount, that's considered tax-free. And it also the discount cannot go below what the employer originally had paid for the item. So if you go and buy and get a free shirt from Kohl's, you may have to pay for that, because if the customer would have to pay $10, Kohl's paid $5 for it to buy it originally. But if they gave it to you for, say, $2, that extra $3 would be considered taxable if that ever happened. Our final couple things here: working condition fringe benefits. De minimis fringe benefits. De minimis fringe benefits are those things that are so small that are hard to keep track of. What I mean by that is you use the employer's copier for personal use, for whatever you have to have something copied. You have something faxed from your employer. You may have gotten like $1 or $2 benefit out of that, not having to pay for it somewhere else, but that would be considered too small to have the employer keep track. Therefore, it's a non-tax free benefit. The other one that has been put on here in recent years is cell phones. If you, and there are some stipulations here, and I thought these were interesting. The IRS has said it's a de minimis fringe benefit if you give your employee a free cell phone and provide them with coverage, only if they meet a couple criteria. One is you have clients or employees in another time zone where it would not be practical for you to be in the office taking calls at that time when they may be in the office. Two, the second criteria that you don't have to meet all of these, but at least one, you have your phone because you have to have it for clients to call you at any time. Maybe it's an emergency type basis, or they need information real quickly. So like a doctor, possibly a lawyer type thing where you need to get a hold of somebody and your clients need to get a hold of you at any time. Or the other one is if you're not in the office very often, you're always moving around, then you would qualify to get a free cell phone and the plan and not have it be taxed. The last one here is tuition reduction for college employees. Notice this is just for college employees and their spouses or dependents. You can get free undergraduate work and not have to pay tax on that benefit, which is a great deal. The undergraduate work does not have to be actually at your school. Your employer may say, well, you can take classes here or an equivalent amount if it's the same price at some other school, and that's fine. You're still not taxed. However, graduate work has to be done at the place that you work. Okay, I know that was kind of a quick overview, but even though it took a little while to go through everything, that was Chapter 3 in a nutshell, Week 4. Go through and get those questions done. Submit them to me by email. I will review them if you get them to me by my date. And then I remember there is a discussion board as well this week talking about income, what's considered income, what's not, and then your opinion on that. I think they're kind of fun to see. All right, we'll see you next week here in Week 5.